This video will help you understand how trusts are taxed. If you don't know who I am, my name's Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. So in the land of social media, there's a ton of information and misinformation on taxation rules, trusts, and how trusts are taxed given those rules. So in today's video, I thought it'd be helpful to clarify in which circumstances you will have to pay taxes at trust tax rates versus personal income tax rates, and that might ultimately help you influence how you're going to structure your estate planning moving forward. So let's jump in. So if you already know quite a bit about trust basics, you can skip ahead. I'll timestamp below to the end of this segment. But ultimately, for those of you who would appreciate it, at a high-level overview, there's two trust types. There's revocable trusts and irrevocable trusts. Revocable trusts are the type of trusts that can be amended at any time. There's no cool tax benefits that go into them. They are not as complicated as irrevocable trusts. And ultimately, they serve as a probate avoidance tool, and they assist with maintaining some privacy as it pertains to one's estate. Irrevocable trusts, on the other hand, they're a little bit more complicated and nuanced. The provisions of the trust cannot be changed once they are implemented, barring unique circumstances where kind of all parties agree. Yes, they also assist with avoiding probate, and they also assist with privacy as it pertains to one's estate planning. However, one of the primary movers behind an irrevocable trust is to gift assets in a way that has a little bit more control and some guardrails, if you will, rather than just an outright gift to a beneficiary. But in addition, as it pertains to estate taxes, they serve a helpful role in families who are otherwise going to have to pay a robust amount of estate taxes on the federal or state level. They can transfer assets outside of their estate well before those assets appreciate to too high of a level, and thus avoid all estate taxes that would otherwise come into play if that asset was held in their estate at the time of their passing. And as part of the genesis of today's video, irrevocable trusts are the only trusts that would pay taxes at trust tax rates, if at all, and we'll jump into that later on. For trusts, there are at least three parties involved. There's the grantor or grantors, and these are the people who are contributing to the trust, transferring assets, gifts, whatever. There's the trustee or trustees, and these are the people ultimately serving as gatekeepers to the beneficiaries, the third group, to decide whether or not a particular distribution will meet the intent of the grantor based on the trust provisions that have been outlined. And then lastly, as mentioned, the beneficiaries. These are the people that the trust is designed to benefit. Now, they don't have unfettered access to the assets within the trust. That is the purpose of the trustee, to serve as a gatekeeper, and of course the grantor for establishing and setting up rules when they do make contributions to the trust. I'll link below to an explainer video that breaks down these two trusts in a little bit more detail. Now, with a revocable trust, the grantor, trustee, and beneficiary can all be the exact same person. With an irrevocable trust, however, that's not the case. It is a cardinal sin for the grantor to also be a beneficiary on the trust. You ultimately want the grantor to make an outright gift to the trust based on the trust provisions and not benefit any more from the assets held within the trust. Now, the trustee of the irrevocable trust could also be a beneficiary. That's okay. And a lot of times you'll see this when it comes to, we'll call it like family property, where maybe all the grandkids are beneficiaries of this trust, and the trustee is just the oldest or most financially responsible, or most well-equipped to make good financial decisions on behalf of everybody else. A lot of times you also see like a third-party corporate trustee. That's at sort of the higher echelons of wealth because they charge a fee, and sometimes the math doesn't make sense for smaller irrevocable trusts. But ultimately, the trustee can also be a beneficiary of the trust, but the grantor cannot. Or I guess should not, if you want the irrevocable trust to still be deemed irrevocable and not include those assets in your estate upon passing. Now let's talk about taxes. As mentioned briefly before, revocable trusts are very simple, and there's no cool tax benefits to setting up a revocable trust. Revocable trusts do not pay trust tax rates. All income that's generated by the revocable trust passes through to the grantor, or the person that's in charge of the trust who is making contributions to that trust, and they'll pay income at their personal income tax rates. Irrevocable trusts, on the other hand, are a little bit more complicated. If irrevocable trusts generate income, if that income is not fully distributed to the beneficiaries, then the trust will pay income tax rates and capital gains tax rates at trust tax rate levels. So just because assets held inside of an irrevocable trust generate income doesn't mean the trust will need to file its own tax return. Now, irrevocable trusts have their own social security number, or also called an EIN number, and they'll use that when it comes time to filing a tax return, but you don't need to file a tax return, essentially, if all the income and gains generated within the trust are distributed to the beneficiaries. Similar to a revocable trust, once capital gains, income, whatever, is distributed to the beneficiaries pay income taxes at the beneficiary income tax rates. But again, if the trust fails to distribute everything, then the trust will pay trust tax rates. And you might already know this, which is why you clicked on this video, but trust tax rates are very confiscatory compared to personal income tax rates. For a quick high-level comparison though, as soon as a trust generates more than about $15,000 of income, and that income is held within the trust and not distributed, they're going to pay tax rates at the same degree as a married filing jointly couple who generates $731,000 of income. At that level, anything above and beyond those two numbers will be taxed at 37%. And so you can probably guess by now, but in almost all circumstances, you'd much rather have the beneficiaries get distributed that income, because you'd much rather the beneficiaries pay income taxes at the beneficiary income tax rates rather than at the trust tax rates. For a quick breakdown, let's look at the marginal tax rates for a couple that's married filing jointly on their tax return. So as you can see, as the couple generates more and more income, they're going to pay a higher marginal tax rate on the money that's within a particular bracket. And of course, once they're at 731,000 plus, they're going to be in that 37% bracket. Now you might already know this, but just to clarify, you don't pay a flat tax rate as soon as you achieve a particular threshold. Income tax rates are on a marginal basis, so marginally you pay the percentage of taxes based on the income generated within a particular bracket. So for example, if the couple made $487,000, then the income between $383,900 and $487,450, that would be taxed at 32%. But not all of their income is taxed at 32%, just the numbers inside that bracket. For comparison though, let's look at how this rack and stacks to the trust tax rates. So as you can see, pretty much the entirety of income is taxed at 37%, unless you're at that, what is that, 15,000, whatever. You can't even see it on this breakdown. So in fact, I'm gonna zoom in here at the $94,000 mark so you can see clearer how those trust tax rates break down. So if we look at the narrowed down income tax rates between married filing jointly couples and trusts, you'll see how quickly the trust income tax rates climb to 37%. As soon as a trust is making over $15,200, they're at the 37% tax rate, marginally on anything above and beyond that. So again, barring any unique circumstances, generally you want the beneficiaries to pay taxes at whatever the beneficiary's income tax rate is, rather than the trust. Let's fast forward, however, and say you've decided you're going to set up an irrevocable trust, and we'll assume it's for the most popular reason, which is to avoid estate taxes, or at least minimize the impact of them by transferring assets that will continue to appreciate out of your estate before things get out of hand. Meaning your assets appreciate too much and you for sure will pay a ton of estate taxes. Good problem to have, but still something to financially plan around. Remember, moving forward in 2026, all the best minds in finance are projecting the federal estate tax exemption to be $7 million net worth, meaning if you have a higher net worth than $7 million, you could be in jeopardy of paying some federal estate taxes when you pass away. On the state level, however, there's a number of states that have their own state level estate tax exemption, which is generally way less than that. For example, in Washington state, the individual estate tax exemption is $2.2 million, meaning if you die with a net worth over $2.2 million, in Washington state, you're going to pay quite a bit of estate taxes on anything above and beyond $2.2 million. Oregon's even worse at $1 million. But let's say we decided we want to move $1 million into this irrevocable trust. Now we need to figure out which assets we want to move. Well, of course, you could pick a number of different assets you want to move into there. You could move all of your gold, or a bunch of stocks and bonds, or a particular piece of real estate, whatever. The number one thing to figure out is, what is the purpose of this $1 million? Yes, we've already decided we'd like to move this kind of out of our estate, for example, but we also need to figure out what is the other benefit to the beneficiaries for setting up this irrevocable trust. Is it to pass on income to the next generation by way of this irrevocable trust? Is the goal to shift income from maybe grandma and grandpa from receiving rental income on this property and paying lots of income taxes to maybe shifting this property into the ownership of the grandkids via this irrevocable trust and having the grandkids pay income taxes on the rental income derived from the irrevocable trust assets? Well, if the grandkids are at a much lower income tax bracket than grandma and grandpa, well, that can make a ton of sense because they're going to pay a much smaller income tax rate than grandma and grandpa. And when you split it up amongst multiple beneficiaries, that even makes the tax rates probably far less egregious than grandma and grandpa. And if the goal is to generate income for the beneficiaries, well, then you probably want to look into income producing assets to move into the irrevocable trust, like a rental property, for example. If, however, the goal is purely just to shield one's estate from future estate taxes, well, then you'd probably want to move into the irrevocable trust assets that are most likely going to appreciate that are not going to kick off a ton of income. For example, a very concentrated stock position with a company that you have high hopes will continue to appreciate. Maybe it's private company stock ownership, or maybe it's publicly traded stock, but for whatever reason, you forecast that this asset is going to tremendously appreciate over the next many years. You might as well keep that inside the irrevocable trust because any appreciation that happens after you've moved assets into the trust will not end up landing on your estate tax return. You completely move those assets outside of your estate. Another thing to consider is if you are trying to pass income off to the next generation or loved ones, but you want there to be a little bit more of a protection for that beneficiary, you might also look into setting up an irrevocable trust that explicitly outlines not to distribute all the income, but to distribute a certain amount, a certain percentage, or give the trustee a little bit more flexibility. I'm thinking in this case, maybe a loved one that's got some addiction issues or whatever, and while you want to provide for that loved one financially, via their health, maintenance, support, whatever, but you don't want them to have unfettered access to however much income is produced by that trust every single year, you might simply just have a small amount of distributions come through to support the health, maintenance, education, and support of that loved one, but then have the trust retain the rest of the income generated and yes, pay income taxes at the trust tax rates. And while yes, they are very confiscatory, and from a marginal basis, yeah, you're probably going to just estimate 37%, that ultimately could be in the best interest of the loved one because you could hurt the loved one even further by providing more financially for them than they otherwise would be equipped to handle. So as you can tell, there's definitely some tax nuance to be aware of if you're going to move in the direction of setting up an irrevocable trust. Again, simply put, revocable trusts don't pay income taxes at trust tax rate levels. Irrevocable trusts may if they retain the income produced by those trusts. Otherwise, if they're all distributed, the trust won't have to owe the IRS an income tax return. And of course, then they wouldn't have to pay any trust taxes at trust tax rate levels. So if that was helpful, if you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Have an awesome rest of your week, and we'll talk to you later. Bye.